We are looking live at the NASDAQ, and the ticker is BYND, Beyond Meat. The stock is currently trading at $1.89, and it is having a very rough morning. As of 10:20 a.m. Eastern Time, the stock is down over 4.3%, a loss of about 8.5 cents on the day. And while that intraday drop is painful, it barely scratches the surface of the chaos surrounding this name. The expectation, the narrative that has been flying around social media forums and chat rooms for the last 10 days is that Beyond Meat was the next great short squeeze. We all saw it. The stock exploded from a record low of just 50 cents on October 16th, skyrocketing over 1,400% to an intraday high of $7.69 just last week. The hype was deafening, the retail buying was intense, and it looked like a classic squeeze was in play. But the reality, the fundamental truth that has come crashing down on the market this week is that this was not a squeeze. It was a liquidity-fueled fever dream, and the company itself just pulled the rug out from under every single person who bought into that narrative. The reality is that this company is fighting for its very survival, and it is doing so by sacrificing its common shareholders. Let's be perfectly clear about what just happened. The catalyst for the stock's absolute collapse from that $7.69 high all the way back down to $1.89 was not short sellers winning. It was the company itself. Beyond Meat just announced the final results of its debt exchange offer. This is the critical piece of information. The company had over $1.1 billion in 0% convertible notes due in 2027, a debt bomb it had absolutely no way to repay. So it offered those debt holders a deal. Swap that old debt for new notes due in 2030, but more importantly, for a massive, catastrophic, almost unbelievable amount of new common stock. We now have the final numbers. Beyond Meat is issuing 316,926,786 new shares. Let me repeat that. 316 million new shares. To put that in perspective, the company's entire float before this was in the ballpark of 65 million shares. They have increased the share count by nearly 5 times. This is dilution on a scale that is almost unprecedented. Every single share of stock that existed 2 weeks ago has just had its claim on the company's future earnings, assets, and value diluted by roughly 80%. The reason the stock is $1.89 is not because of a short attack. It's a simple, brutal mathematical calculation. The company's value is now spread across 5 times as many shares. The rally was, in effect, a trap. It seems retail investors piled in, driving up the price, while debt holders, who are sophisticated institutions, were lining up to dump their soon-to-be-acquired 316 million shares into that rally. The expectation was a squeeze on the shorts. The reality was a flood of new supply from the company's own creditors. This brings us to the short interest, which has been the entire focus of the recent hype. There were claims on social media of 80% or even 100% short interest. The data shows that at its peak it was indeed extraordinarily high, with some sources citing over 40% of the float. But the squeeze already happened and it failed. The current settled short interest data is closer to 14.5% of the float. This is still high, but it shows that many shorts likely covered during that insane ramp-up or were forced out. But the real story for technical traders is not just the short interest percentage, it's the cost to borrow and the fails to deliver. The cost to borrow shares of Beyond Meat, the fee that short sellers have to pay, has been astronomical. We saw spikes of over 200%, 400%, and even 500% annualized. As of today, it's still sitting at a painfully high 46.5%. This tells you that shares are still scarce and that those remaining on the short side are paying a massive price, betting with extreme confidence that the stock is going lower. But here's the actionable data point that investors need to be aware of: the fails to deliver, or FTDs. Recent data from the end of September showed a massive, glaring anomaly. On a single day, 8,736,920 shares of Beyond Meat failed to be delivered. This represents a value of nearly $16 million. A fail to deliver occurs when a seller, often a short seller, fails to produce the actual share certificate for delivery to the buyer at the time of settlement. While some FTDs are normal, a spike of this magnitude is a huge red flag. It can suggest aggressive short selling, potentially including naked short selling, where shares are sold without being borrowed first. It can also point to extreme settlement stress and a lack of available shares. What do you make of the massive 8.7 million share fails to deliver data? Is that a sign of a technical problem or just aggressive naked short selling? Comment below with your take. For investors, tracking this data is crucial. You can find short interest data on sites like Fintel or from NASDAQ itself. You can track borrow rates through your broker or on services like Ortex. When you see FTDs spike like that, it's a warning that the plumbing of the stock is under severe stress. It's a signal of extreme volatility, but it is not by itself a buy signal. In this case, it was a signal of the chaos that preceded the company's dilution. Now let's look at the fundamentals, because this is why the shorts and the creditors are winning. The core business is collapsing. The company just released preliminary third-quarter results, and they are grim. They expect revenue of about $70 million, which is down from $81 million in the same period last year. This is not a growth story. This is a story of decay. Let's look back at their last full report, Q2 of 2025. Net revenues were $75 million, a decrease of nearly 20% year over year. The bleeding was worst in their most important market, U.S. retail. Sales in American grocery stores plummeted by 26.7%. This is where they are supposed to be strongest, and they are getting crushed. Why? Competition and consumer rejection. The expectation was that everyone would switch to plant-based meat. The reality is that in an inflationary environment, consumers are not paying a massive premium for a product that many have decided they simply do not like as much as the real thing. They are not just competing with Impossible Foods, they're competing with cheaper store brands from Kroger, Albertsons, and Whole Foods, and they're competing with traditional, cheaper animal protein. Their food service business, which was supposed to be saved by partnerships with McDonald's, Yum Brands, and others, has also been a massive disappointment. Most of those major partnerships have fizzled out or been discontinued. The financial health is even worse. The gross margin in Q2 was just 11.5%. They're barely making any profit on the products themselves, and that's before you account for their massive overhead, marketing, and R&D. The company posted a net loss of $29.2 million in Q2. Let's think about that. They had, as of that report, about $117 million in cash. Their net cash used in operations for the first 6 months of the year was nearly $60 million. The math is not complicated. The company was on a clear path to running out of all of its cash. This is why the $1.2 billion debt bomb was so terrifying. They had no cash, a negative cash flow, and a massive debt bill. The dilution, while devastating to shareholders, was the only move the company had left to avoid a bankruptcy filing. They essentially converted that $1.2 billion in debt into $209 million of new debt at a higher 7% interest rate and 316 million shares. They kicked the can, but they did it by destroying the equity. So for anyone new to this name, what is Beyond Meat? It was the poster child of the ESG and future of food investing narrative. It went public in 2019 to unbelievable hype with celebrity backers and a story that it would replace traditional meat. The stock peaked at $234.90. Today, at $1.89, it is a 99.2% wipeout. The company designs and sells plant-based meat substitutes, primarily from pea protein. The problem is, the narrative of inevitable adoption was just that, a narrative. It ignored the fundamentals of taste, price, and texture that drive the multi-trillion-dollar global food industry. The company has never, not once, turned an annual profit. Its last quarterly profit was a tiny one, way back in 2020. Looking forward, what is the bull case? What is the expectation now? The previous bull case was the short squeeze, and that has been lethally dismantled by the company's own dilution. The new bull case, the only one left, is a buyout. The idea is that at this tiny market cap, a large food conglomerate like Nestle, Unilever, or Tyson Foods might swoop in and buy them for the brand name. The reality, however, is that any buyer would not just be acquiring a brand, they would be acquiring a business that loses on every sale, has declining revenue, and still has over $200 million in debt. It is far from a clean-cut acquisition. The bear case, which is the short seller's thesis, is simple. The dilution was not the end, it was the beginning of the end. The company is still burning cash, it is still losing market share, its gross margins are still razor thin, the 316 million new shares are a new permanent source of overhead supply. Anytime the stock tries to rally, there will be a massive wall of sellers from the former debt holders who are happy to get out at any price. The analyst consensus is a strong sell,